Good morning, everybody. Welcome to Opening Playbook for Wednesday, September 3rd, 2025. Happy Hump Day. Good morning, Buck, Leland, Rafa. Hi, everyone. All right, let's get started with some pre show content and then we will get into the show. So, if this is your first opening playbook, welcome. The free daily show tries to focus on timely market reviews and trading education. We also try to answer some questions, although we can't always get to all of them because we usually have a few hundred people in the room and we can't get to every single question, but we do our best. We occasionally do some live trading. We're going to look at one or two trades today and occasionally have a special guest, which we also have today. When you get to this screen to get into the opening or closing playbook rooms, don't click on the login text there. Just put your display name that you want to be known by in the chat and click join. You don't need to log in. You can make the display a little bigger by clicking on that hamburger menu in the top left corner. Those three lines will shrink the left column, give you a little more screen real estate for the presentation. In the lower left corner of the display, or of the presentation rather, you will see a speaker icon that is used to mute and unmute the presentation. So if you can see us but don't hear anything, make sure that you're not muted. In the bottom right corner, there are two different icons that can control the size of the presentation. The double arrows will make it full screen, which will hide the announcements in the chat, but will let you see as much detail as possible in the presentation. And the other icon is the picture in a picture icon, which is browser and device dependent. So you may not actually see it depending upon what you're using. If you have it, you can click it to shrink the presentation into a little floating window, which will allow you to do something else in the background without losing the presentation. We seem to have the most luck with this when people use the Chrome browser on different devices. So give that a shot if you are looking to use picture in a picture but don't see the icon. Below the video, you'll see a slider for low latency. This is yellow when it's on and white when it's off. We recommend that everybody turn it off because it will increase the quality of the audio and video that you see and hear, but will just cause a few seconds delay between what we're saying and doing and when you see it. But those few seconds give you better quality and won't make a difference in anything we're doing. So we recommend that everybody turn it off. In the chat, if you'd like to send a message to Nathan, Graham, or me without everybody else seeing it, you can hover over or tap, depending upon the device you're using, on one of our messages, and then click on the double speech bubble icon that you see there. That double speech bubble icon will open a private message to whoever's chat message you clicked on. So if you want to send me your personal information or ask a question without anybody else seeing it, you can do that in the private message. For those that haven't seen it, we have a brand new updated replays page. You can go to marketspg.com/NMC replays and see all the latest. That snapshot's a couple days old, so there are more recent videos than August 29th. But you'll see the last few weeks of replays, and then that'll continue to just grow as a library moving forward. If you want to see anything older than that, you'll need to go into the links that are below the presentation in the announcements section. You'll see a whole bunch of helpful links. The first one is the link you should be using to get into opening and closing playbook. The second one is the replay page I just showed you. And the third one is for the older replays. That one is on YouTube at New Money Crew, and that'll get you older replays, although they're not as complete as the ones that are in the Markets PG page. There are a bunch of other helpful links in there as well. If you don't get our daily scan email and text messages about our events, you can sign up for that in the link there for free. You should also sign up for Nathan and Graham's general Telegram channels to get timely updates and invitations. There's a dollar membership you can get to our opening closing playbook members area that will give you a bunch of training videos and materials, as well as online calculators and all kinds of really useful stuff worth way more than a dollar. But that's all you need to pay for it. So you can use that link to sign up for that. It's also the cheapest way to get into, just being a member in general of Nathan or Graham's programs and getting invited to the members only events like we had just last week. And then the last four links are just some helpful guides that some people may find useful, others may not. How to paper trade, which is a way to practice trading without using real money. A guide to leveling up your options. It says level 2 because that's what we called it, but it's really a guide to all the different options of levels trading. No, all the different levels of options trading. Um, there's a link to our walkthrough of our members area called One Click Trading, and then a video introducing you to our customer service live, which is a really cool thing that we offer for everybody who's a member of one of our programs. You can get into our 3 hours a day, 5 days a week customer service Zoom call where they're doing demonstrations of all kinds of things and answering questions live for everybody to see the answers. And it's a really great way to get your questions answered as well as learn new things you might not have even thought about asking. All right, let's take a quick look in the chat and then we shall go to the theme song. All right, good morning to everybody. We'll get going here.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with a hawk's eye. Options in place in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options in place in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls on their trading phone. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that will fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Good morning, everybody. Welcome to everybody who just joined the room. Let's see. We are going to get going in just a minute here. For those of you just joining us, just give you an idea what we're going to be doing today. Nathan's going to be talking about a pair trade with gold and another trade idea that he has. I think Graham's going to be here taking a look at Apple, but I'm not 100% sure. And we definitely have a special guest. JD Lugash will be here to talk about his favorite value indicator for finding undervalued stocks. So we have all of that coming up in just a minute. And here is Mr. Tucci. Good morning, sir.
Good morning. How's everyone doing today? I don't even have my live chat pulled up yet, so you guys can let me know how you're doing in the chat, and then I'll see it in about 10 seconds.
So far, everybody seems to be having a good morning, or is at least wishing everybody
but hope
else.
everyone's doing well. Excited for some ground. What's that?
No, I don't know what happened. I think
did I cut out there? Sorry.
Just jumped, yeah.
Okay. Yeah, so I'm going to cover some ground today that I don't usually cover a whole lot. So I'm looking forward to that. I'm going to talk a little bit about pullbacks and value, but we're going to cover that pair trade as well. Got a couple notes for you on that. Plus another one that I think is kind of an interesting play as we get rolling here. By the way, really good pop, which served us quite well across the board. Let me know in the chat how many of you guys did well on the pop we got today, because it worked well both for the pair trade and also for the overnight option that we got a nice big pop on as well. Am I freezing up, Graham?
No, you're good.
Okay, I saw someone in the chat. Okay, I saw someone in the chat say frozen, so was hoping that was not the case. Good. If it is, if it is a little bit janky on the video, try that low latency switch button. That will usually, make a little bit of a difference there. But yeah, hopefully you guys did well. We got that nice little pop as we talked about. Apple really popped. It was up like over 3%, now at about 2.5%. But the mags in general up over 2% right now. I didn't actually go back and
Google's up 9% today.
Oh wow, okay. Yeah. So I didn't actually get to go back and look. I would assume that this is the biggest day for the mag since one of those big April bounces. We've seen them actually lead the pack for a while in April and then slow down and underperform. Actually, the equal weighted S&P is outperforming the SPY. The SPY is outperforming the Qs, and small caps are outperforming both. So we're getting kind of an inverse of our typical expectation when we're at all-time highs, and obviously faded off all-time highs, but now trying to bounce back. Graham and I were talking about potentially doing a bit of a deep dive on Sunday night for our members on how we would play the dip, kind of the different key levels, and what we might be buying most aggressively. And we said today there might not be a dip left to buy by Sunday night. So we'll see. Either way, guys, I think we're going to do another members only session on Sunday night. We thought that was really great. Last time it was focused around my intelligence dashboard and kind of a more fundamental understanding of approaching the market. I think this Sunday will be a little bit different. Well, it'll be quite a bit different because we won't be talking about that at all. We'll be talking about some other factors. If we get this pullback, it'll probably be very pullback focused and what we want to buy and how we want to buy it. But either way, there's a couple other things on our radar that we really want to cover, and we want to go through that with members first. So I don't think we have anything up in the members areas yet for you guys, but we will by the end of the day and certainly by tomorrow. So that's kind of the first bit of housekeeping there. Make sure you keep an eye out on your members area for that Sunday night, because that's going to be members only. Last time we did it, that was, insane. We had 1,000 members in there on Sunday night. So hopefully you guys all jump back in. This one will probably be a little more tactical, cover a couple specific trade ideas and things like that for the week ahead. So looking forward to that. But Graham, anything else before I jump in?
We're hoping to be, I think Nate mentioned it. We're hoping to build you a small basket of stocks. September is typically rocky. We've been covering that in here. But there are a few outlier stocks that look really, really good. So we're hoping that we can put together a cool little basket for members on Sunday night. So at 7 p.m. is the time. I think that time worked out well for everyone. It's between some football games too, so it works out good for me.
True. Cool. All right. Well, with that, let's go ahead and jump in. Got a lot to cover today, including we're gonna have JD hop on. He's waiting in the wings in the background right now to cover a couple things. But first, like I said, a couple things on my agenda, and then I actually have something after JD cover. So we're gonna go back and forth just to give you guys a lay of the land here. We are going to cover a couple things on the front end. I'm going to have JD jump in with one kind of value indicator that he likes to look at. And then I'm going to jump back in with a little training on something I don't get to talk about very often. And then I'll give my trade idea during that as well. So kind of bouncing back and forth, but hopefully it'll be all good stuff. And we are certainly glad that you're here. So let me get that added. Looks like there's something else that I need to pull off the stage.
We did have a report just hit just now. The job openings report came in below expectations. Markets popped a little bit on the news, probably anticipating more rate cuts, but it does look like we might be fading this one. So Nate, maybe we will get this continued pullback. We'll see. We'll see how things shake out.
Yeah, I still think if I had to pick, I would say we shake off some of the short-term optimism and grind a little bit lower in the first half. Here, if I had to pick, but I'm not going to try to pick. I'm going to kind of go where things take us and be a little more defensive as I typically would on things like income machine and stuff like that. But I also really like the pairs trade in this uncertainty, and we'll talk about that a bit more today. Yeah, that was a nice one. So, by the way, wanted to mention this. We are getting a little bit more uncertainty in the market. We just alluded to that. Pace is picking up a bit, those overnight gaps. And we're still fairly bullish. We call this neutral bullish. That means we're not in full momentum territory, but we're still overall, short-term trend being undecided, but medium-term trend, long-term trend being obviously bullish, and kind of in that middle market base, which you'll typically see, 0.5% moves versus, you're not getting those 0.1% ranges like we saw sometimes in the last couple of weeks, but you're also not getting 3% ranges like we saw in April, May. Now, the uncertainty that's interesting, I'm not going to give you everything. I blurred out some of this because obviously I want to be fair to my HQ, my all access members, and not give away every single piece of data that they have access to. But I'll tell you what's interesting. I have this volatility analysis that I built. It's all custom data that I built over the last 6 months, and it covers a couple interesting things. What's interesting right now, though, is the custom indicator that is giving us more volatility is actually this candle wick activity. And what that means is that it's really intraday volatility that we're getting. The overnight gaps have really not been trending up. We had a bigger one over the weekend and one today. So we'll probably see this flip green in the next day, if I had to guess, where the gaps come in as well. But if you just look at the last 2 weeks, it's really been the indecision during the day that is causing more volatility, where we get, okay, the market's ramping up. Okay, actually, no, it's ramping down. Okay, actually, it closes somewhere in the middle. And that's what this is measuring. This is a custom thing that I built to try to measure, is the market indecisive during the day? Do we think we're going up and then we think we're going down, but really we end up somewhere in the middle? And we measure the wicks on both sides, and then we average those out over time. And that's where that indecisiveness is actually coming from right now, versus we're typically what you see when we're high volatile. You see big gaps overnight and over the weekend. We're starting to get some of that. Like I said, big gap over Memorial Weekend and a decent one today. So my guess is we'll see this flip green as well. But right now it is looking more like the indecisiveness during the day that's driving that. Okay, with that said, let's jump into the pair trade recap. So this is a trade that we put on yesterday. Hopefully you guys were in the closing playbook. That's our 3:30 daily session that Graham and I do, which is much more active trading. We kind of get into the markets, see what's going on, and we put on some trades. And yesterday, this was our trade. So we bought the September 5th 328 GLD. That's the gold call. And then we bought the September 5th 568 QQQ call. So those were the two positions that we put on. Now, the reason that's what I call a pair trade is because what we're trying to do is trying to protect against one scenario while being bullish in another scenario. Now, usually, folks, what this would look like would be buying a call and then buying a put. So you might buy a call on Amazon and a put on Microsoft, right? So you're long one and you're short the other. That would be a typical pair trade. What we did yesterday was a little bit of a hybrid of that, where we actually bought gold calls because we figured if the market continues to be risk off and fear-based, gold will pop even more aggressively. It was up over 2% yesterday. But if the market bounces back, much like it did, then the Qs, the NASDAQ, should bounce aggressively with it. And that's exactly what it did. The cool thing about this is that both can go up like we saw today. I'll cover that more in a second. But the idea is usually we'd buy a call and a put. Yesterday, we bought both calls because gold in itself is a bit of a hedge. So couple notes here that I think are important. We didn't get to talk about these with a ton of time yesterday. Number one is that your risk per side, per trade, should be consistent. These are two separate trades that you put on with two separate tickets, right? And what you want, ideally, is you want your risk on each side to be pretty equivalent. So a lot of times, one contract will be $4 and the other contract will be $1. But what the problem with that is if you just buy one of each, well, now if the one that's $4 loses money and the one that's $1 makes money, well, you're not going to net make money because the one that has less size made money. So what you want to do is you want to average those out and even those out so that either side winning puts you in a good position. In this case, we bought two GLD contracts per one QQQ contract. So you could have bought two gold contracts and one Qs, or you could have bought 4 and 2, or 10 and 5, or 30 and 15. It really doesn't matter how many you want to do, but you want to even out the risk so that if one way outperforms the other, that you're in good position across the both of them. Now, the other big note here is that we don't use stops or targets on pair trades. Now, this is different than my typical strategy because usually I really love targets and I use targets on most of the things that I do. But with pair trades, we really don't want to do that. And the reason is because pair trades are designed from the outset to take advantage of oversized moves where, yes, you plan on losing on one side, but the other side can overcome that loss by generating 100+%. It could even go up 300 or 400%. Well, if you put a target on that and you cap one side, but the other side can still lose the full value, you're going to break the pair trade, right? Because it's not going to then give you the potential to way overcome the other side of the trade. So we do not use a stop or a target on pair trades. We also don't use a time stop either, and I'll talk about that a little bit more in a second, but we don't want to cap the potential of our pair trade. Now, the other note here, because a lot of questions yesterday were, wait, I thought we were doing a call and a put, and instead I gave you two calls. Well, that's because tickers like gold and Bitcoin and some other ones are unique for pair trades. They're not like a typical stock where you'd have, a long Google and a short Microsoft. Gold and Bitcoin can be used as what I call a hybrid hedge, where they can help you if the market doesn't do what you expect, because they act as a hedge against fear or uncertainty in a lot of cases. But at the same time, they can also move up with the broad market like gold has done so far. And so they are unique. They're not normal tickers. And we use them sparingly but prudently to give ourselves a situation where we can actually win on both sides of the pair trade, but also feel like we have some protection. So those are not like other trades. Usually, if we're using gold or Bitcoin, we'll actually use a call on an individual ticker and a call on gold or Bitcoin. Last note here is pair trades equal break the rules, quote unquote. Now, they don't actually break the rules because they have their own separate rules, but I got so many questions like, wait a minute, Nate, I thought you only use debit spreads when you're trading directionally, or I thought you always used a target. But with pair trades, we're not doing that. They kind of break the rules because they have their own set of rules. They're one of the only times I use regular calls and puts, level 1 options. And the reason goes back to what I was talking about before with the risk. We want a side of the pair trade to be able to generate more than 100% gain if the market goes crazy. Remember, pair trades are my absolute best strategy for very volatile markets. I have two pair trades and two-way trades, but pair trades are the top performer in the most volatile circumstances. And the benefit of pair trades is that they can overcome, huge moves. They can make 200% or 300%. But if you put a debit spread on, unless you put it way out of the money, it doesn't have that same potential. So the only time that I really use call and regular calls and regular puts is when I am trading pairs. It's also one of the only times that I don't have a target because of that same reason. It's also one of the only times that I'm just managing my exits discretionarily, which means, I'm not worried about what tomorrow is or the next day. It depends on how much time is left in the trade and all of that. I might take a 10% net win. I might take a 50% win. I might take a 100% net win dynamically based on what's happening in the market. So just give me a yes in the chat if that at least makes some amount of sense. We're not going to do our full profit pair training today. I'll probably do that sometime next week, especially if volatility picks up. We'll take a moment. But this should give you a little bit of an overview that the pair trade operates very differently than most of the other types of trading. Okay, good. Again, you're not going to have a full understanding from that quick recap, but it should give you a little bit of a framework for why these are different. Okay, so then what happened today on our specific pair trade? Well, we had GLD that we entered at 159. We had two of those, and we should have got out right around 215, somewhere in there. It should be still right around that price, actually. And then the Qs, we entered at 334, and this morning should have been able to get out right around 505. Okay, so somewhere in that range. It won't be exactly the same penny, but somewhere in that range should have given you the opportunity for the exit. So what that meant was that on the GLD, we got about a 35% ROI. Not bad when we held it for about 20 total minutes of market conditions, maybe even about 10 minutes of the market. And then on the QQQ, we got about 51%. Joseph, yeah, I mentioned in Telegram, it's important to keep an eye on my Telegram. Before the market even opened, I suggested getting out right near the market open. So if you haven't got out yet, I would say go ahead and exit. You still should have a nice net profit on these, but this is basically right at the market open. If you guys are taking trades on Closing Playbook, keep an eye on them. Make sure you have notes on what we mentioned on how to exit, and also keep an eye on both Graham and I's Telegrams because that's going to be the best place to know if you're getting out to a trade, if it's happening before the opening playbook even kicks off. Okay, so between these two guys, the question is, what was the net ROI on this position? Does anyone know, by chance, does anyone know what your net ROI, assuming equal risk, on these two trades actually was? Because it's, not as good as it might look, to be perfectly honest. That's one of the sneaky things about pair trades, is that sometimes the gross number of the gains make it look a little better than you realized, because it's not 86%. You're not combining the two, which would be great if you could on pair trades. But yeah, Mike's right. It's about 40%, about 43%, because what you have to do is you have to combine these and then divide them back into the risk. So in this case, you've got about 86% gross gain, but then you're dividing that back by 2 because of the two sides. All right, you guys are on the ball. Normally that trips up traders, but you guys are on the ball there. So yeah, about a 43% net gain. Not bad for about, 10 minutes of overall market exposure from about 3:50 p.m. when we got these trades in during the Closing Playbook to our exit first thing this morning when the market opened. And we'll do more of these, folks. As the market kind of picks up, we will do more of those. And actually, let me actually have one other thing I was gonna mention before I hand it over to JD here real quick. Let me mention this real quick. Our New Money Crew stocks. This is the indicator that you get for free, by the way, if you're on the New Money Crew email list. I'm sure Davis already has a link somewhere in the announcements or can post one. Free newsletter just for being part of the New Money Crew. This is what you get, but it's interesting to note our stocks are really starting to change here. They're a little more unique. You got FLR, a stock I've never traded, CLMT, a stock I've never traded there near the top of the list, versus Palantir and NVIDIA and Google dominating the top of this list. So a little bit of a changing of the guard with some lower priced, interesting stocks there. Okay, I think that is all I got before I get into the power of pullback, something I never talk about, but I'm going to talk about after JD gives a quick segment here. So make sure you get ready to take some notes on pullbacks, because I almost never talk about pullbacks, but I have JD on today, who's kind of the master of pullbacks. And so I want to give you a little bit of an overview for those of you who are new to trading that way, because we usually don't trade that way, but there is some really interesting components there that I want to cover. So I'll get to that in a minute. But first, JD's going to hop on here and give you a little bit of an overview on one indicator from more of a macro kind of fundamental view. That's really JD's background as an analyst, as a Wall Street kind of stock grader, versus Graham and I, who are very technical, very active trading. And so he's going to give you what he thinks is really the most important. I don't want to put words in your mouth, JD. You can hop on here. I don't want to put words in your mouth, but I would say what you think is the most important kind of value grade of a stock, and just a couple notes on that.
Yeah. Good morning. Thank you, Nathan, for having me join you this morning. I do have a presentation, and I guess I'll share my. I'm learning. This is a new system.
yeah. The platform trips people up. Don't worry about it. You'll have to stumble through it a little bit, and then you'll be good to go.
Well, I'm fascinated by your pair trade discussion, because and maybe that's deep in the recesses of your mind why we connected, Nathan, because a lot of what I do is related to your pair trades, where we're finding values, but we're also we can identify stocks that are overvalued as well. So there's a lot of yin and yang to what you said that really is in sync with what I'm going to be talking about today. The origin of the presentation today really started in the late 1990s, Nathan, when I was working, actually I was running a money management company where our model portfolios were outrageously large. We had 500 stocks in a client's portfolio on average, which is way too many. And
a lot of stocks.
That's a lot of stocks. So I took it upon myself to do a research project because I love research, and I wanted to know, the fundamental nature of our business was to identify stocks that would double in value. Our holding period, of course, back then was 6 years, which is a long time. I understand that, but the interesting thing I wanted to know was could we find one number that mattered. And to get into the presentation, here we go. Share screen. I need to grant access, it looks like. Hold on.
You must be on a Mac.
I am on a Mac.
Oh, you Mac guys. Graham.
I'm sorry.
Yeah, the Macs have to grant permission for specific apps to share resources.
Okay. And now it's allow. Okay. Oops.
While he's doing that, there's a question here for the guys. What do you think about shorting SoFi?
I'm not a big short guy in general, so I'll let Graham take that one.
Yeah, I don't. The stock looks really good. It's not one that I would be on the top of my too short list.
Also, Graham's a big he's a big believer in the melt up on the interest rate related stocks like Rocket Mortgage, some of those others. So I'd say more of a buy on pullback than a short for SoFi. Yeah.
All right, there you go, Keith.
Okay, there you go. Did I figure it out?
You've got it.
Okay.
And you've got a beautiful slide to begin with about stocks that can double in value. So wow, you're really going hard here, JD. I'm looking forward.
I can't take all the credit. Your team behind the scenes is so phenomenal, and there's, people should realize. And I mean, Nate and Graham I'm always just amazed by what you guys do. But man, the whole organization is top to bottom just I've been in a lot of publishing environments, and there's nobody better than what you guys do. So they helped me put this together. So in the next 10 minutes, and I'll dive in, I want to show you guys and gals how to identify stocks that can double in value, all using one really simple number. And that's really the output of my research, which is I wanted to make things simple. And let's start the clock here on 10 minutes. So the first question I have for you is, what is the fundamental value of owning a stock? Owning a stock is not gambling, on it feels like we're all playing Mattel Electronics on our phones. Remember those Mattel Electronic football games? And stock trading has seemingly become similar to video games and gambling, but it's nothing like buying a lottery ticket. Most people don't realize this, but it's critical. Stocks actually do have intrinsic worth. Owning equity entitles the holder to a claim on the future cash flows of a company. And that's really important if you want to understand value. It is tangible. Again, it's not just a piece of paper or a share in your account, because owning stock is tangible. It can hold value. But who ultimately decides what that value is? Well, it's the market's job to assign value to the stocks that are listed, right? There's buyers and sellers that ultimately determine what the price of a stock is, and ultimately that is the assigned value of the collective stock market. And over the long haul, the market is actually very good. It's efficient, but not always at assigning accurate values to stocks. In the short term, many opportunities do arise where we can buy undervalued stocks before they correct. The challenge for traders and investors is, how do we do that? Well, for me, I didn't find the answer through a technical pattern or really the encyclopedia of fundamentals. Right? There's a lot of ingredients that determine the value of a stock. Analysts on Wall Street use everything from price to earnings. These are things I'm sure you've all heard of: price to sales, price to cash flow, price to book value, debt to income, and it goes on and on and on and on. Some of these numbers are interesting, but 25 years ago, as I mentioned, I discovered that none of them really matter. I did a deep dive on stocks, specifically looking back at our successes, the stocks that had doubled in value over time. And to my surprise, there was a commonality. There was one fundamental ratio that these money doubling stocks all had in common. What is that ratio? It's the price to earnings growth ratio, also known as PEG. And I am not kidding here. It is the only number that matters. If this number is present in a favorable way, then you have a stock that could potentially double in value. So what is PEG exactly? Well, simply put, PEG is the price of a stock divided by its earnings growth rate. If a stock is growing faster than its price to earnings ratio, I have a candidate for a stock that can double in value. And it's interesting to note, that just should be common sense, right? Because the institutions on Wall Street, that's exactly what they're looking for. They're looking for stocks that are growing their earnings at a rapid clip. And if you can buy those stocks at a discount, you're putting the odds in your favor for success. And I know it may sound overly simple, but I've done the research. I've been in this business for 30 plus years, and it really is incredibly powerful how this one number works. It's basically a flashing green light that tells us there's a mispricing here, and that the markets have incorrectly valued a particular stock. So let's look at an example real quick. In December 2017, I made Eli Lilly my stock of the year selection for 2018. Now, why did I do that? Well, at the time, shares were trading for around $80 a share. And at that time, that may have sounded expensive to some people. Obviously, in hindsight, today with the stock at $700+ a share,
I was
we
going to
all
say, yeah,
know-
me and Graham have said, hey,
I
it's
wish
about
it was
$600.
$80 a share.
So $80, yeah,
right.
we're
but
all in.
at that time, Nathan, there were a lot of folks saying this stock isn't worth $80 a share, right? So, and what I discovered was that at that time, Lilly had a PEG ratio less than 1. And that's the key. A PEG ratio less than 1 is telling you that its earnings are growing at a rate that is higher than the multiple that the stock trades for. And look what happened in just a very short period of time. This actually is just from late 2017, 12 to 24 months later, this stock not only doubled in value, but it went beyond that. So really, really effective or it's just amazing to me how effective. When I see that PEG under 1, then I want to buy that stock. Another name that you may be familiar with is iRobot. And back in the summer of 2022, shares of iRobot traded for less than $40 a share. I did the research, and and back then I was publishing a different newsletter where we were identifying these value stocks that could double in value. And I believe it was late July that I named iRobot my stock of the month in August. And like Lilly, the PEG ratio on iRobot was under 1. But just a few days later, knowing its true value, Amazon comes in. This was literally 2 days after we recommended the stock, put in a bid to buy the company for $64 a share. Now, that bid ultimately fell apart, but I mean, put an annualized return on that 2 days, right?
Yeah.
I mean, it's crazy. And obviously, by the way, this is just good advice. If you own a stock that is acquired by another company, don't wait for the closing. Just take whatever the market's giving you. Usually it's a discount anywhere between 1% and maybe even as much as 5% below the offering price. But when you buy it at 40 and you can get out at 64 in 2 days, that's always a good deal, right?
Yeah.
So, PEG is just really, really, really powerful, and I can't overemphasize. We're all looking for, that magic signal, if you will, and if there is no such thing as magic, but man, PEG does come close to that. Now on iRobot, that was an extreme example, and not every PEG ratio suggests a buyout is imminent or even happening at all. I will say though, in doing a backtrack of all of my recommendations, I was surprised to find that I think the number was around 15% of my recommendations at some point actually got bought out by another company.
Oh, wow.
Which is crazy, right?
Yeah.
So, I mean, if you have a longer time frame, and I recognize your audience of traders, are used to, the lifespan of a mosquito, but there are baskets of capital that can be deployed in a lot of different ways. And for those of you that are looking for a long-term guide or a way to find stocks for the long term, PEG really does wonders. And more often than not, it's the market that will naturally correct the stock's price. I don't ever believe that the market is efficient in real time, Nathan, but over time,
right,
it does get pretty efficient. So another way to look at PEG is just on this scale of 1, and if a peg is less than 1, it does give the stock very, very high odds to double. My time frame, as I mentioned on the money management firm I managed in the late 90s, was 6 years. With this hyper focus on the one number strategy, it got cut in half to 3 years. And it really did. This revelation changed my career entirely. And a little spoiler, as we'll explain later, I can now, using the same mentality and methodology, identify stocks that are about to make similar moves, but doing it much, much faster than what we're talking about. But how about finding stocks right now? Because I do want to give you guys some names. Are there peg stocks less than 1 that I would expect to value over the next 3 years? I did a ton of research over the Labor Day weekend, and really found some great nuggets for you guys. The first name I want to give you is Snapchat. The ticker is SNAP. One real quick way to do peg, if you don't want to do the calculation, is to just simply go on Yahoo Finance and check out their earnings estimates. And what I'm looking for here is if I find a stock that is growing at a rate that is higher than the multiple of earnings, without even knowing whether the peg is below 1 or above 1 or whatever, I just know I have and maybe that's because I'm experienced, but that's a little shortcut you all can use. So in this particular case, you can see here, Snap is expected to grow earnings to 39% in 2026. This year, earnings are supposed to be 26 cents per share. So that's a 46% growth rate. Now, at current prices, Snap is trading for 26 times earnings. So going back, right, you got 46%, a stock growing 46%. And here, if you just use PE multiples, you might say that's an expensive stock, not when it's growing by 46%. So that's a stock I want to buy. And the earnings growth is greater than the PE. This is a stock that absolutely can double in value over the next 1 to 3 years. And with a stock like Snap trading at $7 a share, I'm willing to say it's going to happen in less than 12 months. All right, so that's Snap. Another name I really like is United Airlines. And same process. I'm looking at estimated earnings in the current year compared to 2026. And here, United Airlines is expected to grow profits by 23% from the current year to the next. And where does United Airlines trade today? 9 times current year estimated profits. So growing 23%, trading at 9 times. And again, going back to what is the point of owning a stock? You are entitled to those future cash flows. So a low multiple is important because, a stock that trades for, even on Snap, 26 times, right? Forget about the 46% growth. Your entitlement to that pro rata share of cash flow that your shares entitle you to, it's going to take a long time, the higher the price you pay for that stock. So that's why you got to put these two things together, and the earnings and the growth rate. That's the magic of PEG. And since UAL's earnings are growing faster than its PE, this stock can be expected to double in value in the next 1 to 3 years. And again, that's the formula. Are there other stocks? Yes, I found 3 other names, and I'll leave this slide up for you so you can write it down. Hartford Insurance Group. I won't share the details of the analysis, but suffice it to say that its earnings are growing at a rate faster than its PE multiple. Charter Communications, CHTR, and then Global Payments. And this is a name you may not be familiar with. I wasn't, but boy, when I did the research on it, this is one I really, really liked, Nathan. So that's, well, how about a quick recap? There really is only one number that matters in identifying stocks that can double in value or more. If a stock is expected to grow profits at a greater rate than its PE, not only good things can happen, but it's a stock that can double in value over the next 1 to 3 years. So here are the 5 stocks that exhibit those characteristics: Snapchat, United Airlines, Hartford Insurance Group, Charter Communications, and Global Payments. Whoops. And in a few minutes, Nate and I are going to dive deeper into this concept and tell you how we can take some of these basic underlying market forces and slash that time it takes to see the kind of growth. So instead of 1 to 3 years, how does a few weeks sound? Pretty good, right?
Yeah, sounds great.
Yeah, pretty cool. Well, I'm gonna pick up right where you left off and talk about pullbacks, JD, because I think there's a big opportunity here, and it's something that we don't really talk about in the opening playbook a whole lot, because as most of you probably know, I'm not a big pullback guy. That's really not my specialty at all. I typically rely on clear momentum, and the reason is I think it's just a lot easier to get it right. For directional traders, most traders, if you want to say, okay, is this stock going to go up or down? I would say simplest and easiest way, trade momentum. Trade the current direction that it's already moving. But I don't want to ignore the power pullbacks, because they do have what I would call a secret advantage that other directional plays simply don't have. Now, just to be clear, none of what I'm going to show you, because I'm going to show you some really cool things, just you think about the math a little bit. My folks know that I'm a math nerd, so of course I'm going to go right into the math on this. But none of it really matters unless you can actually time the pullbacks. And that's, of course, where most people get it wrong. But the good news is we have JD on today, so we're actually going to talk through the entire methodology of timing pullbacks in just a couple minutes. So I'm not just going to leave you hanging, I promise, with why pullbacks can be really good. We're going to roll right into, okay, how do you actually time them and take advantage of them? And that's why JD is on today. So let's talk about, real quick, I'll try to go, it's already 10:40, so I'll try to go here as quickly as I can, but give you enough to write down of why pullbacks are so powerful. So, some people would tell you it's because you can get in at a good price. That's the idea of pullback. You get in at a better price, you get in at a discount. But I don't think that really matters for active traders a whole lot. Getting a discount on a stock just in general, I don't think matters for most of them. You guys can tell me in the room if I'm wrong. I think what you guys really care about is what your immediate upside potential is, not just that you quote unquote have some value in your portfolio. And so the big advantage here is that I think you could make imaginary gains from stocks. What pullbacks do is they give you imaginary gains, which was my fun way of saying that they give you the ability to make money that doesn't really exist on the stock. You can pull exponentially more gains out of a stock over the same time frame as the stock itself actually moves. Okay, now what do I actually mean by that? Well, let's take a look at Walmart from December to the current price of Walmart and get an idea here of these imaginary gains that I'm talking about. So since December, way back here on the left of last year, the next 9 months, Walmart has moved 3%. That's the net gain in Walmart over 9 months. But if you bought the pullbacks in Walmart, it had way more gain potential than the stock itself. So you had an 18% move here. You had an 8% move there. You had a 7.6% move there, a 20% move there, a 10% move there, a 9.7% move there, a 6.2% move there, an 11% move there, and we're already up about 2.6% here. Now, obviously, just to be very clear, no one is going to catch all those pullbacks with perfect timing, right? No one traded Walmart the way that I just walked you through. I wish. So I just want to be very clear that I'm not trying to show you that, hey, if you just grab it at every bottom and sell it at every top, you're going to, that's the ticket to trading. If we could do that, sure. But I just want to show you over the same span that Walmart moved 3% net, we actually had 94% of gain potential on the same stock by using pullbacks, because they create pockets of gains that you don't see over the same time frame. And that's really what makes pullbacks so powerful, because let's face it, most stocks perform a lot more like Walmart than Nvidia when you're trading in real time. Sure, if you go back in hindsight, you would have traded NVIDIA and Palantir and all those. But in real time, usually you're battling the ups and downs, and they don't typically move forward like NVIDIA. So finding gains where they don't exist becomes really powerful, right? Think about it like this. Most stocks average a few percent annual return, right? That's what they do. If you hold them over the course of a year, you'd expect to make 5 to 10% on a given stock over the course of a year. So imagine you saw ticker NATE, NATE, was down 20%, and then you expected, hey, over time, it's still probably going to have that positive return. It's a good stock. So here's a question for our audience. How much would a stock that is down negative 20% have to return just to get back to its baseline of plus 10%? What's the number that it would now have to return? Again, not to outperform, just to get back to its normal 10% baseline of what you would expect a stock to eventually recover. Well, obviously, it's down. So it now needs to go up more than 10% to generate a net gain of 10%, right? The stock's down. So in order to get back up 10%, it has to do, more than 10%. That's fairly obvious. But it doesn't just need to go up 30%. It actually has to go up 37%. Okay, so it doesn't just need to go up 30%, not the negative 20 plus the 10. It actually has to go up 37%, which means if you bought a stock down 20% and it bounced back to return a net 10% gain, you just made an imaginary 27% additional return, right? Because anyone looking at the stock is going to see that it went up 10%, but you made 37%, right? Everyone makes sense? So you look at the stock, you say, hey, from January to December, it made 10%. That's what stock buyers made. But if you bought it when it was down 20%, you actually made 37% on a stock that everyone else is seeing a 10% movement. So you legitimately made a 27% imaginary return. Take a look at an extreme example of Tesla after its 2022 beatdown. From here, Tesla gained 17%. Okay, from the highs to the highs, Tesla gained 17%. But Tesla dropped nearly 75% first. So anyone know, let me give you another minute on this one. Does anyone know how much Tesla gained from here? Okay, so it gained 17% from the highs, but it dropped 75% first. So does anyone know from the lows what Tesla gained? And I'll give you just 30 seconds here in the chat to talk about, because again, we're going to talk about what the imaginary gain was when you look at buying it at a discount versus buying it at from high to high. Okay, you guys are much more on the ball here. 75% down plus the 17% from the highs equals a 92% gain. But no, Tesla didn't gain 92%. Tesla gained 371% from the lows, which is pretty wild when you actually think about the chart itself didn't have 371% net gain, but you could still make 371% net gain by grabbing it at the bottom and getting that move. And most of that was, just the imaginary return, right? It wasn't new highs. It was the imaginary return just getting back to the previous highs. But it's just all thanks to how the math shifts when the price gets cheaper. Very simple concept, no magic here, no secret compounding here. It's just the math shifting, and it's a very simple concept, but it's incredibly powerful when you apply it in trading. So think of it this way. Imagine you have a stock that's priced at $500 per share today. And 2 years from now, it's going to be worth $600. That would be a pretty good return. It's a gain of about 20% from today to 2 years from now. But if the price goes down in between, it's going to have a big effect on the potential gains, even though the true gain from here to here never changes. We're not getting a different stock. We're not actually changing what the stock does. We're simply changing the peak and the valley return. So if you buy it at $400, the gain jumps from 20% to 50%, right? So instead of buying it from here, you buy it here. Now your gain is 50%. If you buy it at $300, the gain jumps from 20%, 500 to 600 to 100%. Because now you're trading it from $300 to $600. Pretty wild. And if you buy it at $150, the gain jumps from the same 20% to 400% ROI, right? All because the math changes when the price of the stock changes. Even if the stock does nothing different, it still goes from $500 to $600, but you bought it at 400, or you bought it at 300, or you bought it at 150. Now, don't get me wrong. I think this is important. I am not here to tell you to buy beaten down junk stocks. That's really, really not my suggestion. I hope that's not the suggestion that you take from this presentation. In fact, I hope your takeaway is pretty much the opposite. That you actually want to buy good stocks that have a short-term imbalance, kind of like JD was talking about. I just want to show you the actual numbers, the actual math of pullbacks that I think becomes really powerful. And most people might not even realize that when Tesla dropped 75%, in order to get back to break even, it doesn't have to move 75%. It moves, 300+%. They have the ability to create gains that otherwise don't even exist. Think about a powerful hack in the market. If you buy a pullback and it just goes back to break even, the stock made no gain and yet you made money. That's actually pretty cool when you think about it. Now, let me show you a very cool example of this that JD and I will cover in more detail here in a minute. JD, I hope you don't mind. I stole an example from your track record here just to give what I think is a very cool example of how this works in real time. So with your blessing, I'm going to cover one of these trades. Okay. So this was RGTI. This is Rigetti. I think this is a computing company, if I recall, from back in March. Now, the chart here is not real pretty on RGTI. As a matter of fact, for most of the points in the chart, it's a negative ROI. So, not RGTI. Typed backwards there. So this was negative from the highs, and it never even recovered in this time span. But JD didn't trade the whole chart. Okay, I think this is where it matters. So I looked at his track record. He didn't buy RGTI and hold it for the next 2 years because the gain there would basically be 0%. He actually just traded this little section of RGTI. Okay, now you guys are going to be blown away by what the net gain is because I'm going to give you the underlying stock gain. On this chart, having no scale, no numbers, I would guess that's like a 3% move, JD. Because you don't have scale. You don't actually know what's happening here. If you just showed me this chart and said, hey, what is the stock do? I was like, I don't know. Maybe it was up 10% and here, maybe it moved 2 or 3%. The stock was actually up 42% during this little window. And that, my friends, is an imaginary gain because it doesn't look like 42% move existed on the chart. And in fact, it didn't exist if you just look at the net gain over time. But if you just grab the right piece of the chart, these gains exist. So if you stack those up and use options, well, then it really gets fun, right? Because now you can get the same kind of gains, 20% and 42% and 80% and 100%, but you're not waiting a year like that Tesla trade or 6 months of some of those other trades. You're actually doing this in a matter of days. But like I said at the beginning, guys, that only matters if you can time them. If the timing is right, pullbacks are really powerful. If the timing is wrong, pullbacks can kick your teeth in, right? So the timing becomes really important, and that's why I have JD here today, because I'm just going to be very blatantly honest with you. I don't try to trade this way. I have the pullback thing is not my deal. I don't have the confidence to do it. I don't have the framework that JD has to do it. And so that's why he's here today. And that's why we get to show you the actual pattern. So if you guys are thinking, wow, that is pretty cool, imaginary gains because the stock didn't even move up and JD made 42%, all that. And you're wondering, okay, well, how do I actually do it? Well, you are in the right place because that's what JD and I are here to cover. I wanted to give you a baseline for that. I hope that was helpful just to give you a more conceptual view, had maybe a little bit of a light bulb moment because, guys, the reality is stocks don't move 30 and 40%. It's typically, right? The net gain is usually not there. But from, peaks and valleys, then you get some 40%. Then you get some 30%ers. And that's where the